Private Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshit Kapadia from Elara Securities Private Limited. Thank you and over to you, sir.
Thank you, Steve. Good evening, everyone. On behalf of Elara Securities, I welcome you all to the Q2 FY25 and H1 FY25 earnings conference call of Elecon Engineering Company Limited. We are pleased to have with us the management team represented by Mr. Prayasin Patel, Chairman and Managing Director, Mr. Kamlesh Shah, Group CFO, Mr. Narasimhan Raghunathan, CFO, and senior management team of Elecon Engineering Company. We will have the opening remarks from the management followed by a question and answer session. Thank you and over to you, Prayasin, sir.
Good evening and a very warm welcome to everyone on our Q2 FY25 earnings conference call. On the earnings call today, I am joined by my colleagues Mr. Ayush Shah, Non-Executive Director, Mr. M. Nanda, Head of Gear Division, Mr. P.K. Basin, Head of MHE Division, Mr. Kamlesh Shah, Group CFO, and Mr. Narasimhan Raghunathan, CFO. We have uploaded the press release and investor presentation on the stock exchanges and company's website, and I hope everyone had an opportunity to go through the same. I will start with industry and business overview, and then we'll hand over the call to Mr. Narasimhan, CFO, to discuss the financial performance for the quarter and a half year ended September 2024. Elecon is one of the biggest suppliers of gear solutions in Asia, providing a wide range of products to a variety of sectors, including steel, cement, and power. In India, we are the leaders in the organized industry for industrial gears. We have also been working towards expanding our global footprint and are delighted to share that the export contribution stands at 28% for H1 FY25. We have built a robust distribution network that reaches to 85 countries, thereby expanding our global presence. In recent years, we have also been successful in obtaining orders from a few notable OEMs across several regions. These orders will serve as references for us as we continue to expand into these regions with increasing references and OEM tie-ups. We are optimistic of increasing our overseas business and achieving revenue contribution to 50% by FY30 from overseas business. Elecon has strong foundation for delivering solutions in the MHE division since 7 decades. This experience is supporting us as leading player in India, and we are able to take advantage in the capex environment in India as well as overseas. Elecon has demonstrated throughout time that it is determined and trustworthy partner, greatly meeting the expectations of the clients. We have been known not only as a unique solution provider, but also as the most dependable solution supplier with the shortest lead time. We have also been continuously upgrading our products and capabilities with our in-house R&D and continuous development through innovation. The gear division at Elecon accounts for around 80% of our total consolidated revenue in Q2 and FY25, and it continues to be a vital base of our company. With more than 70 years of industry expertise, we provide a wide selection of engineered and catalog products in this segment, each specifically designed to satisfy the diverse needs of clients in several industries. Our product portfolio is among the most extensive in the industry, giving us a distinct competitive advantage and the ability to meet wide range of customer needs and preferences. Our engineered products are specifically designed and made to meet specific client demands over and beyond our catalog products. These engineered products are custom designed and manufactured in-house with strong support from our R&D team. Our superior quality and services have helped us climb the top spot in the domestic market. Our relationships with customers and OEMs who consistently prefer Elecon are a testament of our commitment. The gear division's revenue for the quarter ended September 2024 was rupees 398 crores, down from 423 crores in Q2 FY24, mainly due to delayed order inflow from clients, which caused a delay in execution in Q2 FY25. However, we see good demand and orders in H2 and are optimistic of achieving our overall annual guidance of FY25. The consolidated revenue for FY25 stood at 732 crores from gear division. Our MHE segment is focused on products and aftermarket services. The strategy of moving away from EPC business has made a substantial impact on our combined sales and profitability. We had a robust 154% year-on-year increase in order inflows in Q2 FY25, demonstrating the effectiveness of our planned actions. Our extensive product line and years of experience have made us the go-to options for clients. Revenue from MHE division grew at 77.8% on year-on-year basis to 110 crores in Q2 FY25. We see this business to evolve rapidly and expect a healthy growth in the balance part of the year on the back of healthy order book. Finally, Elecon has made significant ESG commitments and is firm in its sustainability journey. We are making the switch to renewable energy sources a top priority. Furthermore, we also prioritize the well-being and safety of our employees, implementing various training programs and initiatives to sustain these principles. With this, I would like to hand over the call to Narasimhan, our CFO, for financial highlights for Q2 and H1 FY25. Over to you, Narasimhan.
Thank you, sir. Good evening. Good evening, everyone, and a warm welcome to our FY25 earnings call. I will now take you through the highlights of financial results for Q2 and H1 FY25. Our consolidated revenue from operations for the quarter ended September 2024 stood at rupees 508 crores as compared to 485 crores in the same quarter last year, a growth of 4.8% on year-on-year basis. The domestic market accounted for 76% of revenue and balance coming from overseas market. Our revenues from overseas and export markets stood at rupees 122 crores in Q2 FY25 as compared to rupees 98 crores in Q2 FY24, a growth of 24.2%. The consolidated EBITDA for Q2 FY25 stood at rupees 112 crores as compared to 119 crores in Q2 FY24. The EBITDA margin for the quarter stood at 22.1%. The EBITDA margin saw a dip primarily due to higher freight costs and one-time repairs and maintenance expenses incurred during the quarter. PAT margin for Q2 FY25 stood at 17.3% as compared to 18.3% in Q2 FY24, registering a decline of 100 basis points. For the half year ended September 2024, consolidated revenue from operations stood at rupees 901 crores as compared to 899 crores in the same period last year. EBITDA stood at rupees 205 crores as compared to 219 crores in H1 FY24. The EBITDA margin for the period stood at 22.7%. The PAT for the period stood at rupees 161 crores as compared to rupees 162 crores in H1 FY24. The PAT margin for the period stood at 17.9%. Moving on to the segment-wise performance, Gear Division accounted for 78% of the revenue, while 22% was contributed by the MHE Division in Q2 FY25. In Gear segment, consolidated revenue from operations for the quarter ended September 2024 stood at rupees 398 crores as compared to 423 crores, down by 5.9%. Revenue was impacted on account of delay in receipt of orders from customers, resulting in a delay in execution within Q2 FY25. We anticipate faster execution in balance H2 FY25 to achieve the overall guidance for FY25. The EBIT for the quarter stood at rupees 82 crores as compared to 110 crores in Q2 FY24. The EBIT margin for Q2 FY25 stood at 20.5% as compared to 26% in Q2 FY24. EBIT margin was largely impacted on account of certain one-time repairs and maintenance expenses as mentioned previously, increase in freight cost, especially air freight for certain deliveries to marquee OEMs in the stipulated time frame, and changes in the product mix with respect to engineered and catalog products. However, we are confident as the revenues bounce back, we will be able to recoup the margins with operating leverage playing out in the H2 FY25. The order intake for Q2 FY25 stood at rupees 432 crores, up by 15.2% on year-on-year basis. Order in hand is rupees 627 crores as on 30th September 2024. We see sustainable growth in order booking across sectors throughout FY25. In our MHE division, revenue for the quarter stood at rupees 110 crores as compared to 62 crores in the corresponding quarter last year, growing 77.8% on year-on-year basis. EBIT for Q2 FY25 stood at rupees 29 crores as compared to rupees 13 crores in Q2 FY24. The EBIT margin stood at 26.5% as against 21% in Q2 FY24, increasing approximately 549 basis points on a year-on-year basis. The increase is largely on account of better product mix and higher contribution from the aftermarket segment. The order inflow during the quarter ended September 2024 stood at rupees 104 crores as compared to 41 crores in the corresponding quarter last year, up by 154% on year-on-year basis. The open order as on 30th September 2024 stood at rupees 339 crores. The company continues to focus on the business of supplying products and aftermarket business for its MHE segment, which has led to sharp turnaround in the profitability for this segment. The company is consistently securing new orders for product supply and capitalizing on growth opportunities in the aftermarket business. We have been able to achieve a breakthrough in the overseas market for MHE division and have successfully secured an order valued at $1.65 million in Q2 FY25. We are witnessing a higher demand in the MHE segment from overseas markets. Further, on the balance sheet front, we are happy to state that the consolidated net free cash surplus stood at rupees 500 plus crores as on 30th September 2024. The cash flow from operations stood at rupees 175 crores for H1 FY25 and EBITDA to CFO conversion stood at 117%. Furthermore, we are pleased that the board has declared an interim dividend of 50 paise each at the rate of 50% per equity share of face value ₹1 each. To conclude, we stick to our annual guidance of achieving revenue of rupees 2,225 crores and EBITDA margins of 24% for FY25 and are very confident with the order book we have that we will be able to execute the same in the balance part of FY25. On this note, I would like to open the floor for Q&A.
Hello?
Yes.
Yes, sir. Should we begin the question and answer session?
Yes, please.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ganesh Rajagopalan from Unifi Capital. Please go ahead.
Thank you. I just have a few questions to start with, and maybe the first one is on the margins, right? What we're seeing is the raw material cost just on a quarter-on-quarter basis seems to have gone up. Maybe if you could give us a bit of clarity on what's happening there, and if you could quantify the impact on the margins because of the one-off repair expense you had and the freight expense you have. That's just the first question on margins.
We need to understand that the margins that we have would vary based on the product mix that we have for a particular quarter. Okay. There are differences in margins in engineered products, in catalog products, as well as various models that we produce, which leads to variation in the profit margins. Apart from that, this particular quarter, because of the Houthis' intervention in the Gulf of Aden, we had to pay extra freight to transport the products to Europe as well as to United States, which has also reduced our margins. Apart from that, there are one-time costs that we have to incur, which are for maintenance, which also brought in the variation.
All right. So if I have to interpret what you're saying, you're attributing it mainly to a change in product mix and the freight, and by underlying raw material-wise, you're not seeing any delta. Is that the right interpretation?
Yes. As I told you, there are variations that come in because of the product mix, but we are confident that we will maintain the margins that we have committed by the end of the year, as well as the turnover, which we are extremely confident of doing the same.
So that's about 24% full year, right? If I remember correctly?
Yes.
Okay, all right. So that was the first question, sir. And the second, if you could just give us a bit more color on the kind of delay that we faced in the order inflow, right? What kind of product was this, or where was this client based? Or was it multiple products, multiple clients? Just for us to understand, because we have an order book of about 966 crores, right? So the thinking is, there wasn't an expectation built in, I think, that we would probably see a slowdown. So maybe if you can help us understand why this happened in the gears division, that would be very helpful.
Sorry, it is difficult for me to comprehend the question. But I presume what you are trying to say is that why is it that the first half was slow, am I right? That is your question?
No, the main question was the slowdown in the order inflow. If you could give us a bit more details around it, right? So what exactly happened in the second quarter? Yeah, please.
Yeah, the first quarter, because of the elections, the industrial sector came to a standstill. A lot of our clients were waiting for the elections to get over before they would decide whether to release the orders to go ahead with the projects, etc., etc. Or otherwise were just waiting for the elections to get over and then release the orders. So the inflow in the first quarter was extremely slow, and which caught momentum in the second quarter. Now, for me to execute the orders which were received in the second quarter during the quarter have got tremendous limitations, because only certain types of gears I could invoice it during that time. we have to also understand that we have a short cycle, okay, of execution, and which was the reason why it could not happen in the second half of the H1. But the orders that we have received in the second half of H1, we will be able to execute in the third quarter.
Understood. So for us to meet the guidance that was previously given, this is the last, just to summarize, we'll have to grow about 28% top line, and we'll have to have a higher EBITDA margin, and you're confident that this can be done in the second half. There's no risk to this that you foresee.
Yes.
Thank you, sir.
Thank you. The next question is from the line of Nishchit Mester from Axis Securities. Please go ahead.
Thank you, sir, for the opportunity. So just one question and a continuation of the last one. What are the one-time, so you mentioned that there are one-time costs with respect to maintenance and all. If you could quantify, the maintenance cost which was higher, which was one-time, and if you could also quantify what's the kind of impact we've taken because of higher freight cost.
So if you have, in the last couple of years, we have not upgraded our facilities, particularly some facilities which is required. More specifically on the fire kind of incidents or on account of our other building facilities. So we upgraded to that also. With total amounting to 7.32 crore for this Q2, which is having an impact on this. On account of the freight, so because of this geopolitical tension, to deliver our goods, we have to opt for the air freight, which itself has cost to me additional cost of rupees 1 crore for that also. Over and above, we also have to incur some specific expenses for the material, packing material also because of that different issues. So that has additionally costed me rupees 1.68 crore. So these are the one-time kind of cost which we have to incur because of the change in our supply chain, which has had an additional impact in the P&L for this quarter.
So, and as this freight issue would continue, right, going ahead also, because Red Sea crisis is not yet over. In spite of that, we believe that our margins will be upwards of 25% for the next half.
Yeah, that we already captured, while we have given that 24% EBITDA margin. It is mainly because of the air freight which we have to incur, which was a substantial amount of nearly rupees 1 crore for 1 crore.
Okay. Done, sir. Thank you so much.
We have also taken it up with our clients and requested them to give us extra amounts for the increase in freight, because now the ships are going through Cape of Good Hope rather than going through the Suez Canal. So, majority of them have agreed to it. So, that would not be an issue going forward.
Sir, and our, order inflows, obviously, which came in the second half of the quarter, but in terms of business environment, you believe that the business environment continues to remain fairly strong both in India and overseas?
If I say about this, because of that, in the beginning of the year, for this year, we have given an annual guidance of 15% growth on that we are going to sustain. Okay.
And in terms of visibility for next year, sir, do you think that this 15% growth can increase substantially next year?
Let this period to pass on, because presently, as you are aware, the geopolitical scenarios are still challenging for us. Generally, for the next year, we are giving the guidance in the Q4 earnings call, or maybe in Q3 earnings call, whatever it will work out for us also.
Okay, sir. Thank you so much, and best of luck.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants, please limit your questions to 2 per participant. The next question is from the line of Akash from Dalal and Brocha. Please go ahead.
Thanks for the opportunity. Sir, my first question would be how much of after sales and AMC revenue we would have won both on the gears and the MHE side in this quarter?
Yeah, Akash, may I request you to please repeat your question? I could not hear it clearly. Sorry.
Yeah. Is my voice audible now? Is it clear now?
Yeah.
Yes.
Yeah. So just wanted to understand what is the after-sales and operational and maintenance revenue that we would have done in gears and MHE respectively this quarter?
This quarter, both put together, we have achieved 29% revenue from the after-sales service.
Okay. Would you have the numbers split between both divisions or?
I don't have presently number between the gear and MHE, but I will circulate the same to you through our LG.
Got it, sir. And sir, one more question from a more longer term horizon. So let's say if we talk about for the next 3 to 5 years, both the capex environment within India and the export scenario working out for India through that China Plus One theme. How do you see Elecon shaping up for the next 3 to 5 years? I mean, that I would like to understand.
So far, our growth stories are there. We already discussed, from time to time also, that we are very much clearly focused both in India, being a leadership position in India, both in gear as well as MHE. And at the overseas, we are already getting the traction. And we are adding more and more OEMs orders, maybe small or big, from time to time, on quarter basis also. So we are, sustaining whatever we have given the guidance going for the, future also.
Got it, sir. Perfect. Thank you. I'll join back in the queue.
Thank you, Akash.
Thank you. The next question is from the line of Bharat Shah from ASK Investments. Please go ahead.
I just needed a clarification. I'm still confused about the numbers. You said for the current year, the turnover is expected to be in excess of 2,025 crores.
It is 2,225 crores.
Okay.
Our target is 2,225 crores.
Okay, sorry. So which means compared to 1,600 crore turnover last year, that's almost 40% jump.
No, that you are talking about the standalone. I am talking about consolidated. We are talking about consolidated 2,225 crores. Last year we did 1,936 crores as a consolidated turnover.
Okay. Yeah, sorry, I missed that. And you are talking of operating margins of 24% or EBITDA margins of 24%?
EBITDA margin. EBITDA margin.
So that is inclusive of other income?
No, EBITDA margin doesn't include other income. That falls under the PBT.
So on the turnover, you are saying 24% margins of EBITDA, plus you add other income, that will give you profit before interest and depreciation. Is that what you are saying?
Correct. Yeah, correct.
Okay. So that's really operating profit, not EBITDA, and which is what I was getting confused by. So essentially you are saying the operating profit of 24% or higher on 2,225, add whatever is the other income, and that will be the total EBITDA likely to be.
No, that would be PBT.
Generally, at the different forum are having the different. Generally, we understand EBITDA means it is without other income.
All right, got it. So what you are talking about is the operating profit. Thank you.
So operating profit would be 24%.
Sure. On that you will add whatever is the other income, minus interest, minus depreciation to arrive at pre-tax profit.
Perfect.
Okay. So that's important because other income is large in your context, and therefore I just wanted to be sure rather than being confused.
Okay. Thank you.
Yeah. Thank you.
Thank you.
The next question is from the line of Karthik Kian from Shuyas Advisors. Please go ahead.
Sir, good evening. Very impressive performance under the circumstances. Couple of questions, sir. One is on the MHE side, the very impressive profitability you are achieving. Can you explain, the basis for this? As in, are these fixed price contracts? How exactly are you able to achieve these fairly high numbers? Also, there was a reference to a $1.65 million export order bagged. I hope I heard that correctly. Can you tell me the destination to which this is, and is freight included in this price, or is this on a FOB basis?
Can I give you an off-the-cuff answer? I think it is years of experience in the MHE business which is leading to this. And we have burnt our fingers through thick and thin to realize that we need to change our model. And ultimately, we have seen to it that we only sell products whereby our liquidity has improved and so has the profit margins.
Right. And therefore, these are sustainable numbers and not one-off items, right? I know you've done it for the first half, but I'm still asking the question.
Yeah. Sustainable, absolutely. Okay. And which is the reason why we have changed the entire organization to suit the new model.
The other question would be on the debt side, sir. What would have been the contribution from OEMs in the first half, and how do you see that shaping up for the next half and maybe the next year?
Sorry, we can't hear you.
I was saying, sir, what would have been the contribution from OEMs in the first half, and how do you see that shaping up, say, for the year and for next year?
This year, for the first half, we have achieved the invoicing to OEM of 25 crores.
Okay. And what is the outlook, sir?
We are very much on the track. In fact, we have done better than what we have estimated of at the beginning of the year.
Right. So I was asking you, what's the estimate for the year, sir, roughly?
We are expecting that revenue from OEM business to the tune of nearly 45 to 52 crores.
Right. And have you added any logos in your presentation of the OEM, sir? Because I see the same logos as, say, 6 quarters ago. So you've not added any of the logos in your presentation, right?
No, we have not added the logo. I think
normally 70% of our clients are repetitive. So
sure.
Almost all of them have been almost the same for, I would say, the last 30, 40 years.
I know, but I was wondering if any of the OEMs you are servicing, have you added their logos to the presentation? So that is the question I was asking, sir.
No, that one, no. By the end of this year, once it becomes, because generally in the logo, we consider the more substantial business. So it has not reached to that level also. So, by the end of the year, once it will reach, we will add that logo.
Sure. Thanks very much, sir, and best wishes.
Thank you.
Thank you. The next question is from the line of Pratik Kothari from Unique PMS. Please go ahead.
Yes, hi. Good afternoon, and thank you. Sir, regarding, again, on the demand scenario and order inflow, we did make a comment in the beginning that people are waiting for elections and then the budget, and so now both of those events are behind us. If qualitatively on ground, if you can highlight how are we seeing in terms of order inquiry, pipeline, RFQs, because anecdotally we keep hearing some steel OEM or some paper or someone else, sugar kind of differing the revenues or the targets which they had. So given the optimism that we have in terms of what we intend to achieve, how do we reconcile this, and what are you seeing on ground post these two major events which have happened?
What we find is that, especially in India, after the elections, the momentum and the number of inquiries has been continuously increasing. Okay, the demand for products in material handling as well as in gears is on the rise. Okay, it started a bit slowly, but now it has got good momentum, and we believe that after Diwali, it would further add to the momentum. Okay, things are looking good like before, and we hope that this will continue in the near future. Okay, there are all indications that it would continue in the future. Power sector is heating up. On the other hand, we have mining, which especially coal mining, which is very promising in the future. The third aspect is that steel is doing well, okay, and is expected to do even further. Cement is also going from strength to strength. So these are the areas where we feel that the growth is consistent and is strong and will take us through not only this financial year, but the expectation is the next financial year also would be equally strong.
Correct. And so taking this point on power ahead, I mean, we do read a lot about the new orders which are being placed, the plans which are being revised, be it BHEL, etc., getting a lot of orders. And I think we have done a fine job in terms of, one, guardrailing ourselves in terms of what kind of things we want to do and not do on the MHE side. So if you can just talk a bit more about over the next 3-5 years, given this are very long gestation orders, our preparedness to kind of participate here, capture this opportunity, obviously in the guardrails that we have set for ourselves.
Yes, basically we want to capture the opportunities, but also be extremely careful in not getting drawn away from our strategy, because our strategy is what is bearing the fruits right now. So we need to make sure that we continue on the same lines and continue on the same track, so that in future we do not falter like we have done in the past. Correct.
Fair. And so my last question on the capex. I mean, we had a plan, I think, to spend about 200 crores this year. We have done about 40 odd in first half. So just wanted to confirm, are we on track? And I believe this was largely to kind of add capacity to our existing facility.
We have done the capex because, as Kamlesh Shah had mentioned, that we have, for the last 10 years, we were practically operating on very, very small amounts being used for capex. So we have done this. We have ordered the machine tools and the equipment that we require. They will get installed over a period of time. Okay. However, the orders have been released, and therefore this would be coming in stock. Okay. One of the few initial ones have been received, but the further additional ones are yet to come in.
Correct. Great. No, thank you. Best wishes and happy Diwali to everyone, sir, at Team Elecon.
Thanks a lot. Same to you.
Thank you. The next question is from the line of Bharat Shah from ASK Investments. Please go ahead.
Yeah. I wanted to revisit that question. So pardon me for testing your patience on that. But just to recapture, when you talked about margins of 24%, you did not mean to include other income while computing the margins, right?
Yes.
Now, if you look at your last year numbers on about 1,940 odd crores of turnover, our operating profits, that is without counting other income and before interest and depreciation, were about 475 crores. And therefore, the operating profit margin was about 24.5%. So essentially, what you are saying is, despite the second quarter not looking particularly pretty on this count, here in entirety, our margins will be more or less similar to what we did last year, which was 24.5% operating profit margin without counting other income, and you are saying 24% in the current year, more or less similar, but with an improved top line of about 15%, if not more.
Yeah. Yes.
All right. So it is indeed similar margins, not really any material differences, it appears, in this particular quarter.
Right. Absolutely.
Okay. Thank you. And would you like to talk about some of the earlier participants also did dwell upon this, but beyond the current year, how do you see the unfolding opportunity? And what exactly, and I believe your export business earns you better margins, and which is where you expect to grow at a faster rate over a period of time, while your domestic business will grow, but exports will grow faster. And therefore, overall margins going forward, other things being equal, should be expected to improve. Therefore, if you give some insights into how the business is kind of unfolding, both in domestic and international markets, if you can define it in both qualitative and some amount of quantitative terms, it will help.
Basically, what we see is there is healthy amount of inquiries coming in from the domestic market, which has increased over a period of time after the elections have taken place. I believe that cement, steel, as I mentioned, power, including sugar, are seeing good amount of traction. Okay, we believe that this should continue even in the next financial year, after which one needs to assess how the scenario is panning out. It would be difficult for us to assess beyond that as of now. So that is showing a healthy situation. On the other hand, we have made good breakthroughs in exports. Exports, our growth has been reasonably good, and we believe that from this, it is a platform on which we would be further able to grow. As I had mentioned earlier also in a lot of these conference calls, that our margins are healthier in the export business compared to the domestic business. So the growth in exports would also lead to consistent, if not better, margins in the near future.
Further, I would like to add over here. In the exports, earlier we were thinking the OEM market is there in the Europe and other Western countries. Now we also are getting the good traction from the Russia also because of they got disconnected from the other Western world. Further, if I give on the colors to this, how the margin, the scope for the improvement it is there. Because my gearbox, which is generally are having that warranty period of 6 months to 12 months. Now that will further add the after service business for us. Because we are having the presence outside India, having the direct channel as well as the indirect channel both. Direct channel, that is, we are having our own assembly centers, and we also have our own other subsidiaries as well as the service center, and we also are selling through indirectly through the distributor and dealer network also over there. So with this kind of things, we are continuously evaluating which are the further areas which are there, and with these references from the current OEMs, that will further add the business from the existing OEM, as well as that will open the doors for the other OEMs to for us to capture the business over there.
So will it be reasonable to say that the 15% or better growth that we are expecting in the current year, in the year ahead, in all probability, given the fact that we expect to accelerate in the export business in the total mix, which means it will grow at a much faster pace than the domestic, will it be fair to say that overall growth rate for the year ahead in 25-26 is likely to be superior to these 15% that we are talking today. I understand you mentioned that closer to third quarter or fourth quarter, you'll have a better clarity. But just as a kind of a medium-term picture, conceptually, would you assume that 25-26 will look stronger period in terms of the growth rate than the current year growth rate?
As of now, we believe so. It would be difficult to predict in the future, but looking at all the indicators as of now, it looks like next year would be the growth would be even higher. Okay. Especially we see that kind of scenario, especially in material handling and also in the domestic market in gears. Plus, with the trust that we have in exports, I see a reasonably rosy picture.
Thank you.
Thank you. The next question is from the line of Garvit Goyal from Invest Analytical Advisory. Please go ahead.
Hi, am I audible?
Yes.
Good evening, sir. My question is on the marine sector's orders that we were expecting on. So what is the update on that, sir?
Sorry, can you repeat that once again?
We were looking for some few orders from marine sectors, right? So I'm asking what is the update on that?
The clients have not yet finalized the order. However, we believe that we are reasonably well placed, and we should be expecting orders at least one or two in the near future.
In this year itself, or are you looking to get these orders in FY26 and then execution will happen years thereafter?
We believe that we should get a reasonable success in the third quarter, and which would be executed during the next financial year.
Got it, sir. And sir, I think during this call you mentioned about some order you got in MHE segment. I think I did not remember the number exactly. Can you repeat the number, like 1.65 million, is it right?
Yes, $1.65 million.
This is for MHE segment. This is an overseas order, right?
Yeah, this is an overseas order.
Got it, sir. And so lastly on the capex, like you mentioned 200 CR capex for this year, and now you are saying machine tools have been ordered and will be installed over time. So what is the new figure, like how much will get deployed this financial year and how much will be deferred to next financial year, sir, in terms of capex?
This year we are just completing our capex cycle of 3 years, which we have already spelled out.
That means in second half, approximately 180 CR will be capitalized, right? Because looking at your net flow for first half as compared to March 24, the addition is only 20 CR.
Yeah. So this year, as such, we did additions of nearly 40-45 CR in the first half, and we are expecting the more machines to reach over here in the H2, and I think most of them will get installed in this year itself.
And the revenue will start kicking in next year, right?
Yeah, that will start next year.
Got it, sir. And sir, just to understand it better, like you mentioned, and customers are delaying the orders. So is there any specific reason for that, why they are delaying the orders, or can you comment on that?
Pardon, I can't guarantee what you mean to say. No, delay in the order, what? Yeah, because of election, the order flow started from July, August onwards. So generally we can invoice in the same month or in the same quarter for catalog product, which is called the standard product. Whereas the engineer product, which is having the manufacturing cycle of 3 to 4 months, that is not getting rolling out to the next Q3. If you have seen my balance sheet, the inventory has increased to 194 crore as of 30th September 2024 against last year as of 30th September 2023, it was 152 crores.
Perfect, sir. That's it from my side, sir. All the best for the future.
Thank you very much.
Thank you. The next question is from the line of Mohit from Chris PMS. Please go ahead.
Hi, sir. Thank you for taking my question.
Can you be louder, please?
Yeah, 1 second. Yeah, can you hear me now?
Yeah.
Yeah. So my question is on the product mix side. What exactly are we seeing the impact on product mix? I mean, which products are getting more impacted? Can you just elaborate on the same?
Which product mix? In Q2, because our order info started from July, August onwards. So my execution was more of the catalog product, that is called standard product, vis-a-vis engineer product. So because of the change in the product mix, that will have that impact on my gross margin as well as the EBITDA margin.
Just to be, sir, more clear, you are saying catalog products were sold more than the engineered product vis-a-vis last year.
Yeah, correct. My product mix was not, last year it was better. Last year we did the engineered product of nearly 55%, and my catalog product was 46%. This year it is the reverse form.
All right. Thank you, sir. That was it.
Ladies and gentlemen, due to time constraint, this was the last question for today's conference call. I would now like to hand the conference over to the management for their closing remarks.
Thank you very much. Hello?
Yeah. Thank you for joining this call and showing your interest in Elecon Engineering. We intend to charter a journey of becoming a leading international player in the gear solutions market. We further double-click by showing a stable increase in overall overseas market share in this quarter, and we plan to maintain this momentum. On the domestic market front, we have a healthy order book in hand, and it's time to showcase our execution in the next half year to achieve the guidance number for FY25. With this, I would end the call. Should you have any additional inquiries, please feel free to reach out to SGA, our investor relations firm, or our CFO, Narasimhan Raghunathan. Your participation is greatly valued.